Well, good morning and welcome from a very wet Melbourne this morning. I'd like to warmly welcome everyone to today's webinar. As part of our welcome, I'd like to acknowledge the traditional owners on the land from which we meet today. They're the Wurundjeri people of the Kulin Nation. They are the traditional custodians of the land on which I present to you today. I'd like to acknowledge all elders past, present, as well as emerging leaders who continue their role as proud custodians of the country of which they belong to. I'd also like to acknowledge our Indigenous clients and our colleagues who join us around Victoria and Tasmania today. My name's Adam Holster. I'm the Executive of Professional Services Banking in Victoria. I proudly lead a team of 12 bankers who support our customers and clients across a range of professional services industries every day, including real estate. And that's the purpose of today's webinar. We're really proud to provide you a quarterly update on what we see happening in the market based on previous data, but also based on our economics forecast data as well. Joining us today, we have Mark Browning. Mark's the head of valuations at NAB. He's been at NAB for the past 6 years. He heads up all of our residential, our commercial, and our rural valuations, of course, as well as business valuations. He looks after all of our panel, operations, valuation risk, and reliability. Mark's been a career banker for 25 years. And his previous leadership roles have been across corporate and business bank through credit and risk. So a really well-rounded skill set that Mark's able to bring to us today to lead us through a conversation on what he's seeing. I'd also like to welcome Gareth Spence. Gareth is the Senior Economist, Australian Economics at NAB. In Gareth's current role, he analyses the Australian economy, provides advice on economic developments, both internally to NAB, but also engages a lot of our clients face-to-face and also the media and many other organisations with what's going on in the economy. Gareth's team more broadly, the group economics team, provides perspectives on domestic and international forecasts. They're all available at nab.com.au. A core part of Gareth's role is the responsibility for the well-regarded Australian business surveys. And I know that just Tuesday we had a couple of surveys released, which I think Gareth will reference in his information today. Gareth's been with us since 2018, after 10 years with the RBA, where he worked in economic analysis and research. So a really well-rounded background as well, and probably pretty pertinent with some of the questions and the queries, which I suspect might get thrown up through the Q&A function today. And I'd encourage you, as we go through today's content with Mark and Gareth, please put your questions in the chat. We'll either try and address those in real time for you, but we'll certainly have some time towards the end of today's presentation to be able to address all of those as well. And like always, if we can't answer it on the spot, then we will take your details so that we can come back to you. But with that, I'd like to hand over to my economics colleague, Gareth Spence, to provide a perspective on what's going on in the VIC TAS economies. Gareth?
Thanks, Adam. I'm just getting the screen share up. All right. Thank you all for having me today. I guess in the time available, I'd like to just run you through some of kind of the big themes globally and locally that are sort of playing out at the moment and touch on their sort of relevance for the property market, but also kind of their feedback loops back into the residential property market. So kind of jumping straight in, a global perspective is pretty important for Australia as a small open economy. Obviously, a lot going on, but just to sort of summarize broadly, the context that we're in now after a very sharp increase in rates across the globe following the pandemic. The good news is inflation has peaked and it's easing. So we continue to watch that quite closely. Lots of the supply shocks that came out of the pandemic are indeed fading. Now, as we look forward, kind of more local and domestic factors will sort of start to take over and drive sort of each country. But, for now, it is easing. The good news about that is it looks like rates, are at or near their peak in most advanced economies. And flowing on from that, growth has kind of slowed quite sharply across most countries, but the labour market has generally remained quite resilient to date. So, kind of the flow through of monetary policy still playing out. Obviously, some big risks around the globe still playing out as well, with geopolitical risks in the Ukraine and the Middle East, as well as maybe a bigger slowdown in China. But I will leave it there for the globe today and move to kind of what we're seeing a little bit more domestically. So, how are the rates, higher rates and the strong rates or the high inflation we've seen in Australia kind of playing through is sort of my first big shock to kind of talk through today. Obviously the key impact we're seeing is through the impact on household budgets. Obviously they're being stretched and the balance sheets are kind of coming under a bit of pressure. You can see on the left-hand graph where we just sort of track household disposable income growth in real terms. So that's household income after interest and after the impact of prices. You can see that it's fallen by around 3.2% over the year. So a little bit unusual, certainly a notable fall and something that is pressuring budgets. I guess you can see there that the real pressures are coming through the light blue bars, which are the impact of higher prices over the year. So the price level, according to the CPI, is now around 15% higher than it was in 2020. As I said, household disposable income has fallen by around 5% over the year after the impact of prices. We can also see that in the green bars there, the impact of interests payable by households is kind of rising relatively sharply, and it's having its largest impact for quite a while as rates have risen. Maybe just a couple of other things to note really, though, is that there are some key offsets to kind of this drag on households that we're seeing at the moment. One is the very strong labour market. So, more people in employment than ever, and wages growth picking up, at least in nominal terms, seeing labour income really, really kind of grow. And for those that have savings and other assets, a bit of a boost from the interest receivables there. To kind of summarize it more directly in a mortgage sense, you can see that the burden from both interest and scheduled payments has risen quite sharply over the last year as well. It's now around its highest level since 2012, where rates were a little bit higher, but certainly flowing through to the kind of household sector. Where are we seeing this show up is probably strongest seen through our consumer stress index or our consumer sentiment survey. Maybe a little bit unsurprisingly, the lower income part of the distribution, younger age groups, those with larger household sizes, the unemployed and renters are generally reporting the highest level of stress, though obviously the impact of rates and inflation has kind of played out everywhere. I guess another way to sort of just cut that quickly is to say that consumer sentiment has been quite weak as a result of all of this. So, kind of around GFC lows and has kind of tracked that way for sort of its longest period on record. Business confidence, on the other hand, certainly has weakened, but it's kind of stabilized at a slightly higher level. So it's certainly below average, but it is tracking a little bit more positively when compared to previous downturns. So how is this really playing out for us in the actual economy beyond the sentiment and into the kind of what consumers are spending? Well, unsurprisingly, we've seen 3 quarters of kind of cuts to discretionary consumption after a very strong boost following the reopening of borders and the end of lockdowns. That said, the falls have been generally quite small to date, and the level of spending is still quite high. Something we've continued to track coming out of the pandemic, where we saw a very big boost to goods spending as households were restricted from spending on services, is kind of that rebalancing between the goods and services, and goods spending has certainly leveled off while services continues to edge up. Again, like the discretionary component, still relatively elevated compared to pre-pandemic. One thing is that overall growth in consumer spending certainly has slowed. It's not falling away, but it's not growing at the pace it was pre-pandemic. And that's sort of one of the key adjustments we're seeing as an impact of those pressures on household budgets. The other key dynamic is sort of what's happening to the household savings rate. So this is a flow measure and what the households save each quarter. In a net sense, that has fallen to its lowest level since pre-GFC at about 3.2% after spiking during the pandemic. So something we continue to track, but for now, households appear to be kind of adjusting in a somewhat gentle way to kind of the pressures they face, at least in aggregate. There are certainly pockets of stress kind of across certain groups, but overall household consumption is not completely falling away. And I guess, as Adam sort of alluded to in the introduction, where this really comes out quite strongly for us is business conditions in our NAB monthly business survey. So each month we go out and we ask businesses, what are your trading conditions? What are your employment levels? And how is your profitability? And we can see that that's certainly eased since early this year from a very high rate, a very high level, and is now back at around +11 as of Tuesday. That's certainly come off where it was, but it is still well above average. So sort of the broader story there is, while there is kind of a bit of pressure at the individual level on consumers, in aggregate, actually trading conditions have held up quite well for the business sector. And generally, it's true that conditions have remained quite strong across most industries, including retail trade and rec and personal services, where you think maybe the consumer has a bit more of a direct impact. At least one part of that story and why we're seeing that resilience in aggregate in contrasting to kind of the pressures we're seeing maybe more at the individual level is the very rapid rebound in population growth we've seen since international borders reopened. In the year to March, Australia's population growth nationwide rose to 2.2%, which is its strongest rate since late 2008. That equates to around 550,000 extra people, or 450,000 new migrants over the year. While that data is a little bit dated, we do know that the Labour Force Survey measure of civilian population shows a further acceleration into the September quarter, where population growth looks to be tracking at about 2.8% at the moment. At the state level, for Victoria, this is certainly playing out very similarly to the aggregate. So population growth to March was around 2.5%, its strongest level since the late 2000s. The big story there was really the addition of 137,000 new migrants after a period of kind of net outflows through the pandemic. Maybe for Victoria, an interesting dynamic is the fact that, at least till March over the year, and a bit of an unusual impact of a net amount of people kind of leaving the state for other states, whereas maybe that's a little bit more neutral in normal times. It is correcting, something we kind of continue to watch. For Tasmania, I think the story is a little bit stronger. So in contrast to actually most other states, Tasmanian population growth is actually still slowing after a period of quite strong growth in the state pre-pandemic. Obviously, the big sort of swing driver there is still net migration, where it's kind of rebounding as borders have opened. But in contrast to pre-pandemic, interstate migration is actually now a drag on population growth in the state following a period of relatively strong growth pre-pandemic. So one of the things besides consumption and the economy more broadly is that obviously population growth is having a strong impact on the housing market. I'll leave it to Mark to talk you through a little bit more details on actual price movements, but I guess a couple of things I'd just like to highlight from our big macro perspective is, we've certainly been surprised at the resilience in house prices. They declined by about 9% from their peak to trough about a year and a half ago. Since then, things have actually picked up quite strongly through 2023, and that comes despite a very sharp reduction in borrowing power with higher interest rates. So, for the average person or the standard person, borrowing power starts or has fallen by about 30% and can be significantly higher depending on who you are. So the rebound in prices has been quite broad-based. but unsurprisingly, places where population growth has been strongest and rebounded more strongly have seen kind of stronger and ongoing rebounds. Again, that strong population growth is certainly played out through the rental market as well. So rental vacancies around their lowest level on record. They're generally very low across the states, with the exception of Hobart and Canberra, which have actually picked up, albeit have ticked down a little bit in recent months. And I guess Mark will touch on this a little bit more detail, but that's resulted in quite a strong rate of rents growth over the last year. It has eased a little bit recently over recent months, but it still does remain very high. And again, I guess the contrast there, where we see Melbourne still actually increasing while most other capitals have sort of begun to slow. And Hobart, again, the standout in contrast to most other states, where rents have actually fallen over the past year with that increase in the vacancy rate, and again, reflecting the impacts of population. Something that comes up is, obviously on the supply side, so population growth is contributing very strongly on the demand side for the housing market. On the supply side, when we think of the number of dwellings completed, Australia-wide, that has kind of trended lower in rolling annual average terms over the last year or so. We're down to around 175,000 completions across the country as of March. It looks to have picked up a little bit in Q2, but generally quite a bit lower than what it has been pre-pandemic. When you look at Victoria, that sort of mirrors the overall picture nationwide, where it's still high, but it has come off where it was. Tasmania has picked up, notwithstanding a bit of a recent fall. So, kind of the backdrop here is that strong rebound in population growth amidst kind of a bit of a slowing in the supply side. And I guess, some of the things we can kind of look at on the supply side that we know, our residential property survey, which will be released next week, sort of asks a range of questions, but one of the key questions at the moment is, what are the barriers to new housing development? And you can kind of see on the right-hand side there that for Q3 and indeed Q2, construction costs and rising interest rates really were weighing on the sentiment around new housing development. They have eased slightly in Q3, but generally do remain quite high. In terms of official data, we have some information on input costs. You can see there that price levels have kind of leveled off. So overall, the input costs into construction are around 30% higher than they were pre-pandemic. The rate of inflation certainly has slowed, but we actually haven't seen much of a correction in prices yet, outside of things like steel products and maybe timber. So I guess sort of a positive offset maybe on the supply side, or the challenge that we're kind of looking to in the near term as well, is while completions have come off, the pipeline of work remains very high. So the number of buildings under construction or about to be commenced is around 270,000. It's about its highest level sort of on record. You can see that is true sort of in Victoria and Tasmania as well. And so, while the uncertainty of construction costs and higher rates are certainly weighing on the completions and the construction sector more broadly, there is a pipeline that will provide some support, at least in the near term. I guess the challenge going forward is we've seen quite a pullback in the level of approvals for new builds, which are the inflow into the pipeline. They've tracked to around their lowest level since 2012. And so, as we work through that pipeline, we're going to need to see building approvals pick up in order to kind of match that rise in population growth. So what is the net impact? I guess there's obviously kind of the price and the rents impacts that we've seen in a broader sense. We obviously talk about cost of living quite a lot at the moment, given the strong inflation backdrop of which rents are part of the story. The net wash up is that housing has become quite a bit more expensive. So PropTrack has put together some new affordability indexes where they go out and they sort of assess, what share of sales over the past year could those on a median income purchase, spending 25% of their gross income on housing. And you can kind of see that has come off quite sharply as rates have risen quite quickly and house prices have actually, leveled off, if not risen quite strongly in some areas. So for both Victoria and Tasmania, their affordability indexes are a little bit below, so less affordable than the national average. I guess turning more broadly back to the cost of living, the positive news, like the global story, is that we think inflation has peaked in Australia. It has eased from around 7% back to around 5.5% at present. Lots of those global supply side disruptions, labour shortages, factors are starting to fade. And we are seeing some of that now feeding through to prices. I guess the question is, how quickly do we return to the RBA's target from here? And a couple of ways that we think about this is the tradable impact, so the impact of imported goods on inflation, where we saw a very sharp increase in goods prices through the pandemic. They are sort of disinflating. Some prices are actually sort of returning back to normal. But really what we're focusing on is the non-tradable, so kind of the services part of inflation that has a much stronger domestic component, where we think, labour costs and domestic factors are much more important. That has turned, but it is still very high. And I guess the tight labour market backdrop that we look at the moment poses some risk. So despite that very strong increase in rates and the slowing in growth that we've seen to date, like the globe, we've actually seen quite a resilient labour market. The unemployment rate has tracked around a 50-year low for the greater part of a year now. Employment is now 1 million people higher than it was pre-pandemic, despite falling by about 800,000 at its worst during the pandemic. And alongside that, job vacancies actually still remain quite high, despite all that employment growth. So they have come off their peak mid last year, but are around 70% higher than they were pre-pandemic. And we think that, that return in population growth has eased some of that pressure, but generally, the level of spending and activity in the economy is still kind of providing some support for the labour market. For Tasmania, job vacancies are still around 100% higher than they were pre-pandemic, so still quite strong labour demand in the state. For Victoria, it's a little bit lower, but it is 70% higher and 100,000 available positions at present. In terms of the unemployment rate, Victoria is around 3.5% at the moment, and Tasmania is around 4.5%, so both well below their pre-pandemic levels. So where does that leave us in terms of rates? Well, we still think the RBA will be pushed to do one more hike at the next meeting before rates remain on pause for a relatively extended period into mid next year, and they begin to kind of ease back towards a sort of a more neutral level. I think, as we sort of touched on when talking about inflation, whether they go higher and alternatively how soon they cut will really depend on what happens to that domestic inflation pressure. Part of that will be what happens to wage growth in a tight labour market. So we've certainly seen wage growth accelerate to its strongest rate in nominal terms since around 2012. But at present, it doesn't look inconsistent with inflation returning to the target. I guess the risk we're watching is just how long the labour market stays that tight and what the impact to inflation is. There's also a range of other factors, such as the exchange rate, which has depreciated a little bit more recently, but generally takes a sort of a longer time to pass through. And we contrast that with the actual disinflation we're seeing across global goods prices, providing some offset. For now, it looks like the labour market is sort of the key risk. So how do we think that all plays out? To kind of summarise it, well, in aggregate, GDP growth will be slow for the next couple of quarters before sort of picking up as the impact of inflation and rates kind of wanes on household budgets. We expect below trend growth both this year and next year, and that slower growth will really translate to some easing in labour demand. And that sees the unemployment rate rise to something a little bit more normal, like 4.5% from the exceptionally low levels at the moment. But I guess quite importantly, it's important to remember we don't see outright job shedding. It's more that population growth is quite strong, and that slowing in labour demand is just failing to sort of offset that over the next year or so. For inflation, we remain optimistic that it will continue to kind of moderate as long as wages remain relatively contained. We see inflation falling to around 4.2% by the end of this year, and just above the RBA's target band at 3.1% by the end of next year. And, that will allow the RBA scope to eventually kind of to ease policy or begin to ease back towards neutral as inflation settles back towards the target band. So a bit high level, but I might leave it there and sort of hand it over to Mark for some more detail on the price and rent parts of the markets.
Thank you, Gareth, and thank you again for the invitation today. Just to orientate you to the remarks that I'll be sharing today, they'll cover the overall property market nationally, just to start with, just to orientate us, and then look at the respective local markets from there as part of what we'll be looking to cover. Give me a second. So we know how important property is for our country and for our interests, and this slide just covers that nicely for us. Worth around $10 trillion in housing, as well as the $1.3 trillion in commercial real estate. And just as an update for you, we'll have some remarks around it during this morning. Sales over the last 12 months, around 470,000 residential sales that have occurred. We know that's an important for many of the professional services customers that are on and clients that are on today's webinar, but more broadly, it's a key driver of our economy right across the sectors, whether you're joining from professional services or more broadly across our business or business teams across NAB and our contacts. So this just sets out for you how the respective markets have been tracking over the last quarter and annually, both houses and units. And you'll see there the respective, I guess, measured growth in the Melbourne market and still easing phase that's occurring in Hobart. And this just provides some contrast across the country to set the scene today for us. If we look specifically to the last 3 months, and we're going now to a national picture, you'll see on the right-hand side the quarterly change for both metro, combined capital cities and regional markets. And on the left, the breakup. Regional markets now back growing 1.3% for the quarter, 2.5% for capitals nationally. But if we turn specifically to Melbourne, 1.3% over the quarter. Regional Victoria still easing by 1, and Hobart easing by 0.2, and regional TAS off by 0.4 as well. So gives you that perspective of the more measured growth in Melbourne capital, but still some easing and softness occurring in the regions and across Tasmania more broadly. If we take another look at the segments, though, segments of the market, we're talking about the quartiles here. So this is the 25% of the market that's most affordable, the mid 50%, and the 75% quartile, which is the highest quartile of values. And you'll see in Melbourne, it's performing relatively consistently. The mid and higher tiers just slightly above for the last quarter. In Hobart, in contrast, it's the top end of the market that is driving that easing phase that's still occurring there, and the most affordable quartile of the market is in a growth phase over the last quarter. From an sales activity sense, capital cities here are 1.8% below their 5-year average. Regional markets off 6.1%. But specifically, if we draw our attention to focus on the specific capital cities and regional markets, and recognising that the last 12 months and period before with record low levels of interest rates saw a higher level than average around housing and dwelling sales activity. So you'll see there Melbourne is off 19.1% in sales, and the same time last year Hobart off 4.6%, and regional VIC off 21.2%. and regional TAS of 17.8. Just really reflecting what was a really strong level of activity during that record low levels of interest rates, and returning to a more normalised level from a sales activity sense subsequently. If we turn our attention to Melbourne specifically, bottom of the page reflects the performance of the market from dwellings, houses and units, and for the month, quarter and the last 12 months to give you a sense as to how the market's been performing in more detail. So for last month, we saw house growth, dwelling price growth continue to increase, a measured 0.4%, so up 1.3 as we've said during the quarter. It's 4.3% higher than the trough of the market at the start of the year. And as we know, Melbourne listings are on the way up. New listings up 26.3, which is consistent with this time of the year. We're in the spring peak selling season, but it's on the higher side of the norms, and their total listings just up 1.4% on the same time last year. And as I've said, sales are on for the year to September are more modest than the year prior. Average days on market's a good early indicator, performing well. 28 days there, less than the same period last year. Again, showing limited ranges of options, albeit some uptick more recently of for purchasers to make decisions on. Vendor discounting more modest, but as Gareth was mentioning earlier, growth in Melbourne rents have been really strong, and houses up a bit over 11%, and units up 13%. Units reflecting some rebound from the lows experienced during the pandemic, but really just again with vacancy so low, and with the available options both from a properties listed and rental listings, it's not unexpected to see some growth occurring in both price growth as well as rental growth as well. We look at the locations, and I do like this visual around the market. We shared this last time we were together. This gives you a sense that the blue, the darker the blue, the more the price growth over the quarter, and the more the pinky or redder colour is prices easing for that last quarter. So that just gives you a snapshot across the greater area of Melbourne as to the markets that are moving, and in summary how they've been performing. For those that are perhaps more like a table version of that, here's that version, both giving you a monthly and quarterly by the SA4 regions across Melbourne, and some remarks both on rentals as well as selling days at a region level, so that you can get a sense as to how each of those markets are also performing. And perhaps just to finish out on Melbourne before we go to the regions, here's just gives you again by Melbourne region some of the annual change in sales volumes that's been occurring across those locations as well. If we move to a regional Victoria, again you'll see there is a variation both monthly and over the quarter as to the rate of growth. There was flat, there was no growth, no contraction, no easing last month, but that more broadly has still been easing occurring across the entire regional Victoria. But you do need to go to local markets to understand how each of those that has been performing, and it's largely been Ballarat that's had the softest conditions, and in contrast, Shepparton has been experiencing strong growth. And on the right-hand side there, you'll see both time on market, rental growth, and activity at that region level to give you a sense as to how that market's been going. Before we move to Tasmania, I thought we should just round out the picture of Melbourne by providing just a couple of insights on the commercial property market and also rent rolls for those that are interested in there, and then I'll follow those remarks with time spent in Tasmania, so bear with us. So for commercial in Melbourne, we know industrial property has continued to be the standout. Strong demand for both owner-occupiers, for investment, and some uplift occurring in the rents being achieved. Largely, that's more than offset the level of adjustments in yields and in cap rates, and some examples of previously tenanted owners making purchase decisions to control their own future, given the CPI and rent increases that they have been subjected to as well. So, particularly in the mid-market and below segment of industrial, still continue to see some solid activity and rent growth occurring. Retail, perhaps a little bit more mixed, depending on the location and the type of retail that's been occurring. Not unexpectedly, CBD is still going through an adjustment phase. Suburban has benefited from that, but also now more recently experiencing the cost of living and impacts from the interest rates, depending on discretionary or non-discretionary nature of the retail. So still a mix across retail. Still some good examples of property selling well, but also some languishing on the market for extended periods of time as well. So a more mixed story in retail. Office, I'm not sure there can be too many more column inches or articles online written about office, but that has been a big feature both nationally, globally, but also in Melbourne. We've got new supply still coming online in Melbourne, and more broadly, we've had a flight to quality in that space. Vacancy levels remain elevated, and we're still in a transition phase in the office market. Suburban office, however, seems to have held up a little bit better, depending on the size, the floor plates, and the types of tenants that are being attracted to that. So more still to occur in the office space, and that's very much a watching an area of further adjustment as the interest rate phase and working patterns continue to adjust. On rent rolls, just some insights here across the VIC TAS markets, just to give you a sense as to how those have been trading and activity in the space. Look, largely the similar themes as I shared in our last catch-up. Very much a theme of some of the portfolio being sold, and the numbers of changes on Victorian tenancy laws have contributed to that. And in its place also, strong rental growth occurring across the space, as we've touched on earlier. So a range of different factors at work there, but still, broadly speaking, good demand for rent rolls across the board, and good support. We turn to Hobart firstly. As I said earlier, Hobart is still in an easing phase, down 7% on the year, and still easing on the last month and quarter. Listings are up there, some more options available there, and that has seen a lengthening on days on market and an increase in vendor discounting that's had to apply. There's still options in that market, and at some stage, the flow of the attraction of affordable properties in that location, and also with perhaps more from work from anywhere approach or other employment opportunities may be sufficient to drive that market back to equilibrium. But at the moment, it's as I said, it's in that easing phase, and that's consistent right across dwellings, houses, and units more broadly, other than just for the quarter for Hobart more specifically. If we turn to the sorry, as Gareth mentioned, and the houses and units rents in Hobart as a result are in that easing phase also. We turn to the visual. Here's a snapshot of Hobart, Greater Hobart over the last three months, showing that the parts of Hobart that are in growth and those that are still in an easing phase for a visual, and bringing that up from both a metro and regional perspective, you can get a sense here as to the parts of Tassie, both from a dwelling price, rental values, and selling conditions around how the market is performing more broadly. So, Adam, I might bring you back into the conversation now to host us for questions, and thank everyone for their interest and attention today.
Good on you, Mark. A really comprehensive update, and really appreciate Gareth's perspectives as well. We're into the Q&A. There is a Q&A button on the bottom of the Zoom screen, so please feel free if you do have a question. I've picked up a couple here, and so I think they're worthwhile going to right away. I think that when you consider, and this is a joint question, Gareth and Mark, when you consider the factors impacting both, I guess, playing out in the economy and also some of the local factors, Mark, that we've seen through, that are impacting on the supply side as well. Just, I guess, bringing that all together, what do you think that means for agents, in the market, sort of looking to market and run their businesses particularly well, both on the sales and the rental side, and also what does it mean for investors and owner occupiers around making decisions, either entering or exiting the market as well?
I'll kick off, Gareth, if you like, and then please add some further thoughts there. So I think at the first level, the more certainty that the RBA provides, the more people who are currently sitting on their hands and thinking they'll pick the inflection point in the market will elect to jump back in and become more active. So in the first instance, Adam, I think that the continued reads on CPI and the like, and speculation every first Tuesday of the month, or will we, won't we, and further rate increases just does take a little bit of that pause and caution for some, particularly investors, but for some owner occupiers as well. So I think once we're past that part of the cycle, and that seems to be closer than further away, then I think there'll be renewed activity, and people will be making be in more confidence condition to make decisions and proceed. I think in Victoria, we've still got some way to go to work through the implications of both the housing announcement more recently, Airbnb, and all those types of short stay accommodation announcements, as well as the prior tenancy and taxes. So there's a whole range of factors from investment and from an owner occupier point of view, particularly with secondary dwellings, still to work through the market. And I definitely think that will cause lots more portfolio reviews or dwelling style reviews, which could result in further sales or investment decisions being made thereafter, Adam. So I think from that sense, agents, as I'm sure they would always do, will stay close to their client base and supporting with information as part of that. But yeah, until we get through that next phase of whilst I think spring will be okay, I think it will take to be over that RBA uncertainty and into the next phase of the cycle before we see a more significant uptick in that activity, Adam.
Your thoughts on that, Gareth?
Look, I think Mark was pretty spot on, to be honest. I guess I would sort of suggest more broadly, I think lots of the factors, I think Mark used the nice word, I probably should have been clear on this, the adjustment is still ongoing, right? And we will kind of see that continue for a while. I think, the big trends of population growth will stay there and that will support prices. The challenge in the short term really is the supply side of the market for both rents and I guess housing more broadly. But, you know, like there are some positive signs on that. The government is increasingly focused on how do we adjust to, you know, housing supply and not just some of these other kind of policy adjustments around Airbnb. So I guess I'm quite optimistic that, you know, this is a bit of a key driver for reform in sort of those sectors as well. You know, I don't think we're going to see maybe the large adjustment that we saw in house prices that we may have expected at the beginning of all of this. And maybe supply kind of will hopefully normalise a little bit in the market too.
Well, it does beg the question then, Gareth, and I know you didn't specifically call it out in your presentation, but probably two things, I guess. Are we expecting to see a major downturn in Australia, you know, at least one quarter, potentially a couple of negative growth, for example?
Yeah, look, I think, you know, I'm quite optimistic on this. I think, you know, the lesson we've learned globally is that, you know, there's certainly some challenges going on, but actually the economies have remained quite resilient. So there's a couple of reasons for that, right? The first one probably primarily is, you know, policymakers don't operate in a vacuum. So they are forward looking and they, you know, their goal is not to kind of crush the economy unnecessarily in a sense. So, you know, it's sort of where we're at with the RBA now. And I think, you know, Mark is right. Maybe there is, let's say, some increasing certainty that we are near the top. We certainly think we are, barring anything else sort of going wrong. And I think part of that is just the gradual approach, right? So they know that rates have risen to a level and we're going through this adjustment phase and they're watching very closely kind of what happens. I think, you know, population growth more broadly, so certainly an adjustment at the individual level, but population growth really is supporting, right? It's supporting the business sector. It is supporting consumer demand in aggregate and also just the healthy labour market. So, you know, we think things will, you know, pressures will ease a little bit, but we don't expect like a massive fallout or kind of, you know, a big downturn in the labour market that leads to kind of ongoing scarring. So, you know, the hope for now is that, you know, I think I've sort of been describing it this way, but, you know, Lo had talked about the narrow path. Maybe the path is a little bit wider and hopefully it's a bit more of a 6-foot track, right? So we kind of, you know, navigate that relatively easily. At the moment, I think, you know, we certainly are seeing a slowing in growth, but you know, it's coming from very high levels of activity. So it's kind of a balance there on how that all plays out.
Thanks, Gareth. Hemalatha asks, can we have a copy of the presentation? Absolutely, you can. So one, we're recording the session, so feel free to play it back at will. We'll provide a link to that one, but also a copy of the presentation for anyone who's registered for the webinar as well. Peter asks, Mark, just about a snapshot of the commercial market in Hobart and surrounds for industrial, retail and office.
It's a good pickup from Peter on mid-flight and presentation, and notice that wasn't included today, Adam. So I'll look to update that and what's shared, Adam, so that that's available more broadly at a high level. You know, lots of similar comments would hold true, but probably not to the same level of strength, either in the positive or the negative, in Hobart and Tassie more broadly, Adam, at a high level. But happy to make a slide available on that one.
So, Peter, in that that information that we get out to you, anyone that's registered, Mark will have a commercial slide in that one as well. I would say though, Peter, we're very conspicuous. If you want to connect on LinkedIn and sort of further the conversation, then you know, I'm certainly up for that conversation. I've got no doubt that Mark would be as well. So please feel free to connect with us, but we'll make sure that we include some information on commercial in the pack that goes out. Eileen asks, Mark, a view on the current student accommodation and short-term rental markets, serviced apartments, hotels, that sort of thing.
Yeah, there's a bit in that space, Adam. You're right. You know, with the return of students to Melbourne, you know, that's been one of the significant contributors to the demand for rents and the uptick in prices that's being attracted as a result. There has been a wider underinvestment in student accom more broadly for during the whole pandemic period, to be real, and there's numbers of announcements that you'll see in media occurring at the moment around that, but they all take time to deliver. So in the shorter term, I absolutely in the camp that will still create some pressures, particularly as more students are being asked to return physically and be present, and as Australia continues, and Melbourne as the education capital of Australia is seeking to return more international students. So I think in the shorter next couple of years, there's still pressures there. And more broadly, some of the longer term supply still to come to the market in that space. On perhaps the second part, Adam, still lots more water to go under the bridge around short stay and the like, Adam, and we will see where that all lands. Hotel style accommodation, we know that during the pandemic there was a significant investment in increasing the fit out number of hotels here, new supply of rooms as well. And it's great to see some more of the Melbourne activities, events occurring. That's keeping that occupancy at pretty healthy levels, but probably still a longer term normalised level to be set, Adam, for the longer term. So still an adjusting phase happens as supply is returned to the market and new suppliers and other suppliers taken off for upgrades as well, Adam.
Thanks so much, Mark. Damien asks, looks like this one, well, actually, I think you can both chip into this one. How do you see easing inflation and less interest rate hikes? So I guess that's sort of, softening or petering out that you were talking about, Gareth, impacting house prices in Melbourne in 24?
Yeah, look, maybe I'll jump into it at the start and Mark can kind of follow it up. But I think, we're revising up our house price outlooks. It's been quite hard, obviously. The big surprises we've seen despite the increase in rates. We expect prices to kind of continue to rise, maybe at a slightly slower pace over the next couple of months, which sees prices end the year across the capitals up around 9 to 10% over the year, which is quite phenomenal. We think that sort of slowing will sort of continue, but we'll still see prices up, around 5% next year. So I think, a bit of it is sentiment and the uncertainty kind of being removed, as Mark highlighted a bit earlier. I think population growth will be kind of still quite the dominant factor in the near term for prices as well, which is a key support. And eventually, as the RBA does sort of ease, whether it happens mid to late next year and just how quickly, but eventually, easing rates will provide some further support to that as well. So, notoriously hard to forecast house prices, obviously, but I think, some quite strong supports, at least over the next year.
Thanks, Gareth. Mark, Greg asks, there seems to be a softening in rental prices in Mornington, specifically, so Mornington Peninsula, I guess more broadly. Of late, could this be people moving back to the CBD post-COVID?
Yeah, look, I think that was probably inevitable, Adam, given big parts of Melbourne moved down to the peninsula and took advantage of that. There's numbers of people that have been maintaining the two properties and two addresses and doing a couple of days in the city and a few more down the peninsula and taking advantage of lifestyle. I think with depending on the stage of life and the financial positions more broadly, that's not unexpected that level of activity might normalise and might see some softening in more properties on the peninsula becoming available and therefore softening of rents. Also think, as we touched on earlier, the change of tax regimes as well with the state government announcements will also be a factor in this as well, particularly for Mornington Peninsula. But there's definitely lots of people that took advantage and brought forward perhaps longer term retirement plans to more permanently base themselves on the peninsula and only come back a few times a week as opposed to the daily commute. But with everything that's kind of gone really solidly during the COVID times, there'll be some easing back of that. We saw record levels of price growth and rental demand on the peninsula during that phase, so it's not to be unexpected that more normalises, Adam.
A couple of adjacent metrics potentially as well there, Mark. I certainly know, looking at the both public and private school enrolments and that sort of thing, they are well up across the peninsula, and that is sustained. That does not look like a one-off spike. So some of those locations like Dramana, Rosebud, Toorak College enrolments, those sorts of data points as well. So give us, I guess, a reason to believe this. While some might be moving back, there's certainly a lot that have made the stay for good, at least those kids.
Yeah, I mean, I think that's right. As Mark highlighted, right, we've ended up probably in the middle ground. It's not all completely work from home and work remotely anymore, but it's certainly, we're not quite back at the point yet of everybody in the office 5 days a week, and maybe that's not something we will ever sort of fully return to.
Hemalatha asks just about some insights around business purchases and sales in Victoria, Mark.
Yeah, that's a good one, Adam, and that's probably a longer conversation than we've got time for today. Look, I think in a couple of comments just to set the scene there. There are still transactions occurring. I think given the higher rates, particularly if they need the purchaser is looking to fund it with debt, then that is taking some longer time to work through the due diligence and feasibilities and negotiate that through. If it's a bolt-on or something adjacent as a bulk up, those transactions still seem to be going through okay. I think it would be fair to observe, though, Adam, things are taking a little bit longer to conclude than they were at during the peak of the market, but it's all industry dependent, business dependent and purchaser dependent on what their intent is with those as well. So bit to unpack in that, but still occurring, but just a bit slower would be the headline to take away.
Yeah, well, I'd say, Hemalatha, if you want to connect for a conversation on that, more than happy to have that longer conversation that Mark alluded to, because there is quite a bit there. But I think the amount of succession that needs to take place across the Tasmanian and the Victorian business communities, particularly in the small business space, is just phenomenal. How those transactions are going to play out over the next 10 years is probably anyone's guess, but potentially not, more traditional consolidation. But I think we'll see some emerging business models and ownership models and that sort of thing come through as well. I know we've been talking about that looming succession issue for a number of years, but it really is, with those business owners sort of getting into their 70s and 80s, it really is crunch time for a lot of those businesses now. Damien asked, building approvals look to be on the rise. Materials seem to be more available. There does still seem to be the challenge of access to labour, to builders, etc., which may impact growth. Any thoughts on that one, gentlemen?
Yeah, I mean, I can take that. I think agreed. In short, I mean, I think we know that kind of those supply pressures are sort of easing in a material sense. The labour market is still very tight, right? So job vacancies are kind of obviously quite elevated even in the construction sector, despite some of the challenges we've seen on profitability. And indeed in our survey, right, one of the things is business conditions have held up. That's actually construction that's sort of, it's eased across the survey more broadly, but construction's actually seen a bit of the improvement more recently as kind of supplies come on. And I think it does generally reflect that very tight labour market around, 50-year lows in the unemployment rate, but a very big pipeline of work. So I think that is definitely the challenge in the near term for the construction sector.
Gareth, thanks so much. And with those questions and almost at 10:30, that brings us to a close for this quarter. Thank you so much for joining us. We'll, of course, be back in the new year to talk about the quarter that has just been and again, sort of forecast and look ahead. But thank you so much for joining us today, and we'll see you next time.